It is time for perhaps the most anticipated interview of the morning. And for that, I'm going to hand it over to Sapre because we all want to find out what really happened at Franklin Templeton Mutual Fund with their debt schemes. And more importantly, can investors expect their money to come back to them quickly? Sapre.
Surabhi, thanks very much for that. Joining in now is Sanjay, Sapre, President, Franklin Templeton, India. Mr. Sapre, good morning. To begin with, can you just explain to us what went wrong? What happened between March and April that was so wrong that you took this unprecedented step to wind down 6 schemes?
Before I answer that question, I just want to clarify a couple of points. These are questions we've been hearing from investors, and I think it's important to clarify them. The first is that there's a lot of concern about, does the winding up of the funds mean that I've lost my money? And I want to clarify that the winding up of the funds does not mean a write-off, and investors will receive their money over a period of time, depending on how we are able to liquidate the maturities and the coupons we receive, etc. Right? So that is an important point, I think, for investors. There is also a fear that we will wind up other funds. And unfortunately, for a brief period this morning, there was a misleading news article that we had wound up some additional fund of funds, which is absolutely not the case. So I also want to assure people that there is no question of our commitment to India. That commitment remains steadfast. All our other funds, besides these 6 funds, remain open for subscriptions and redemptions. As you know, Sumera, we have over 25-year history in India. We have more than 1/3 of our global workforce based here, and we remain committed to our investors and our business in India. Now, to the question of what went wrong in April, I'm sure you can imagine, in March and April, I'm sure you can imagine the decision to wind up these 6 funds was extremely difficult, and we only made it because we believe it was the only viable way to protect value for investors and give them an orderly realization of the portfolio assets. Over this period of March and April, and particularly coinciding with the time when the lockdown was announced, we started to see significantly reduced liquidity in the bond markets for most debt securities, but particularly for securities that are rated below AAA. And we also saw unprecedented levels of redemptions in the fund following the COVID-19 outbreak and the lockdown. And I think for a period of time, and the March numbers for redemptions for the industry also look extremely elevated. Now, as you know, these schemes have been in existence for a long time, maybe 10 to 15 years. They've followed a consistent investment philosophy. They've seen many market cycles, and were able to meet redemption payment obligations across all of these. And even when the lockdown was initially announced, even though we did have redemption pressures and liquidity in the market was drying up. But once the lockdown was extended, the funds were simply not able to generate the required cash from their underlying portfolio in order to fund redemptions. In the last 6 months, we were able to generate a significant amount of cash. In fact, a large portion of it from below AA rated papers. But all of that changed once the lockdown was announced. And I think the lockdown obviously caused concerns for people, but it also removed the risk appetite from the market, and it limited liquidity to very few issuers. So when we found that we were not able to fund redemptions from the underlying cash flows in the scheme, we found that we were having to resort to borrowing and increasing levels of borrowing. We felt that was unsustainable. It was value destructive for unit holders who remained in the scheme, and therefore we had to take this very, very difficult decision to wind up the schemes.
But Sanjay, was this really the only choice? I mean, what were the options that you might have considered before you took this decision to wind down, and what was it that finally made you take this option?
So the choice in favor of winding down was made purely on the basis of what is, in our opinion, best for investors. So the choice we found ourselves in, Sumera, was, do you create daily liquidity at any cost, or do you preserve value for investors remaining in the fund? And we felt that creating daily liquidity at any cost in a market environment that was illiquid was actually penalizing investors who stay in the scheme at the cost of investors who are redeeming from the scheme. And so that was the principal basis on which the decision was made. In terms of options, we explored all the options that are available within regulations. So we looked at suspending redemptions, but regulations only allow a redemption suspension for 10 days in every 90 days. And you still have to pay out about 2 lakhs per investor per day in each scheme. First of all, 10 days was not enough in our opinion for a dislocation of the kind that the pandemic has created and the lockdown has created. And obviously the liquidity to support 2 lakhs a day was also a challenge. We looked at elongating redemption payments. So, these funds typically pay T+1, but regulations allow you to go till T+10. Again, that's a relatively short-term measure. We even considered whether we should do a distressed sale of assets. But one, there's very limited risk appetite in the market. So you couldn't really liquidate significant parts of the portfolio even at distressed prices. Every subsequent sale was likely to engender higher and higher discounts and value destruction. And as I said at the beginning, we didn't feel it was appropriate to create value destruction in the portfolios to pay redeeming investors at the cost of investors who are going to stay in the fund. So therefore, then the only viable option left was to wind up the schemes. So that was the only way to stop the redemptions and allow the funds to make an orderly exit from its portfolio positions.
Sanjay, the biggest criticism that has come in is that there was a large intersection of papers in, the different categories of the fund. So, the objectives should have been distinctly different, isn't it? Why would the ultra short-term fund also have credit risk and so much of it?
So all these funds followed a core philosophy of generating yield by investing in papers that were rated in investment grade, but from AAA to single A. Each fund then followed the regulations either in terms of portfolio composition or in terms of duration for the category in which that product was categorized. We do have independent funds which invest only in AAA kind of securities, and these funds continue to be open for subscriptions and redemptions. They are managed by a separate team within the fixed income group, and they are not significantly impacted by the dislocation in the market. So while it may look like all of the funds have the same securities, actually the individual security selection was based on the fund's core philosophy of investing across the rating spectrum, the duration needs of the fund or the portfolio composition needs of the fund, and our assessment of the attractiveness of the credit. While it may look also that all the funds are holding the same bonds, actually in many cases it is the issuer that is common, not necessarily the underlying instrument.
But Sanjay, isn't that really the same thing?
No, it's not actually the same thing. You are looking at the attractiveness and creditworthiness of the issuer and deciding whether that bond issued by that issuer is suitable for the product construct that you are creating with the scheme that you're looking at, and each scheme is then assessed independently. If the bond met the needs of more than one scheme, then it might have been taken in more than one scheme.
Okay, did you consider or did you use part of your domestic balance sheet to buy some of the bonds to furnish liquidity to the funds? I mean, you were one of the more profitable AMCs as per percentage margins. So why was that option not considered? And I mean, did you consider it? What was the outcome?
So given the size of the funds and the size of our domestic balance sheet, it simply wasn't possible for us to create the necessary liquidity for the required length of time with the cash that we had available on our domestic balance sheet, Sumera.
Okay, so where does the regulator feature in this? Did you formally or informally inform SEBI prior to taking this decision? And what was the observation from their end?
So we did keep the regulator briefed throughout the process, and I must appreciate that they were very open and supportive throughout.
But they didn't offer anything more concrete in terms of suggestions?
So we had a number of conversations with them, but eventually, Sumera, the decision has to be made by us and by our boards and our trustees. And I think the regulator understood the situation we were in, but eventually it has to be our decision, and therefore it was our decision.
Okay, did you at some point look at approaching the Reserve Bank for a line of credit? Was that an option?
We looked at various options, but please remember a line of credit, even if it is offered at low cost, is still a borrowing. And we didn't feel it was prudent to continue borrowing for long periods of time because it wasn't very clear to us how long this market dislocation and illiquidity would remain.
You know, Sanjay, at the time of the JSPL credit event, your parent had offered you a line of credit, I think 1,000 crores if I'm not wrong. Why didn't you approach them this time? Or if you did approach them, what was their feedback?
So given the size of our franchise and breadth of fund offerings and the size of these funds, the company was not in a position to provide the required liquidity support either. So we did look at all of these options, Sumera. As you can imagine, decision to wind up 6 funds, that too in a category that I think we were very early entrants in and where we had significant success over many years, was an extremely difficult decision. But we felt, having explored all of the options that we've discussed before, it was the only way to prevent value destruction for investors and to allow us to distribute proceeds to shareholders in an orderly manner.
You know, Sanjay, the biggest blame has fallen on the big uptick that we saw in redemptions. But if you see the AUM fall in the ultra short category, it was in line with the industry, right? I think everyone saw between 35 to 39% in terms of an outflow. In fact, if you see the latest April numbers, you'll see that there's a gross inflow of about 5,000 odd crores. Yet you continue to see outflows even now. So what is it that has gone wrong, just at FT?
So I'm not sure about that mid-month number. Smita, I haven't seen the mid-month numbers for this month. We at Franklin clearly saw our redemption spike after the lockdown was announced in March. And while I think that trend normally reverses in April, if one goes by history, this year we did not see that trend reversing. I can only surmise that the pandemic, the related lockdown, led to a significant loss of risk appetite, which both heightened redemptions for these types of funds and dried up liquidity for the assets that we were holding in these funds.
Okay, you mentioned earlier that it was too late to consider restricting redemptions to even 2 lakh rupees a day per investor. But could this decision, if it was taken, say, in early April, not have been better? Why did you wait till the 23rd and, have to reach the stage of winding down? Why couldn't you have restricted redemptions much earlier, in early April?
So I think, Sumera, I should be clear, it is not that we waited till the very end. All of these options were under discussion for a period of time. But as I said earlier, at whatever point of time you would suspend redemptions, you could only do it for 10 days. Now, that is a very good liquidity management tool if you have a short-term issue. This was not, in our opinion, a short-term issue because this was something that was created by the lockdown, and I don't think even today we have full clarity on exactly when we will return to normalcy and how we will return to normalcy. So at any point of time, even if we had done it earlier and even if we'd been able to generate the liquidity to support that 2 lakhs, which remains a question, simply that length of time to be able to suspend redemptions only for 10 days was not an adequate tool for us to manage this situation.
Sanjay, did you seek an extra borrowing limit from SEBI in early April? What was the maximum borrowings that you had in these 6 schemes as of the 23rd, and did any of them exceed 20%?
So the regulations, as you know, allow you to borrow up to 20% of the fund's AUM. And yes, we did seek increased borrowing limits in some of the schemes, and we had to use these borrowing limits as well in a couple of cases. But the sustained redemption pressures didn't go down, and the liquidity in the market for these assets did not return. So we could not see how we could both fund redemptions and reduce borrowing in a meaningful time frame. And therefore, we did not feel it prudent for the schemes to continue borrowing increasing amounts of money to fund redemption obligations. And that, as you're aware, can create negative consequences for unit holders who remain invested in the fund.
Okay, Sanjay, we have many questions for you, but we have to take a break. I request you to stay on the line with us. We'll come back in just a moment. Do stay on. We'll be right back with this conversation.
Brought to